I don't often do this. I usually don't take an article I wrote earlier in the week and turn it into a podcast. But I think what I touched on this week was important enough to maybe bring it into a more open format. If the first phase of the AI trade was about creation, building the chips, the data centers, the large language models, the second phase is about the implementation, the application. And for us as investors, portfolio managers, wealth managers, this shift requires a fundamental rethinking of where alpha or excess returns will be generated in 2026. Welcome to The Money Runner. I'm David Nelson. The era of easy beta, blindly buying into the Nasdaq 100, that's likely coming to an end. Because if I look at the market right now, the current landscape, the backdrop, the math suggests that maybe the most explosive returns may no longer come from Silicon Valley, but maybe from the most unlikely of places, the boring economy, those sectors of the economy that have been left for dead. You know, there's an old adage, they call it the law of large numbers. Well, what about the law of large multiples? And if you're going to talk about large multiples, that's likely going to take you to the technology complex. Now, let's get this off the table right away. I'm not a technology bear. Far from it. I'm fully invested in technology companies. But I think we're going to have to be more discerning, you know, because I think what's happening right now, we're starting to push the edge of the envelope on a lot of companies right now. And I'm looking at a lot of companies that are trading 30 to 100 time earnings where the growth rates maybe don't support that. If you're growing at 30% and you're paying 30, 40, 50, even 55 times earnings for that kind of growth rate, I could buy that. Okay, you talk me up, I could buy that. But if you're growing low double digits, 15%, and you're still paying 30, 50, 55 times earnings, you got a problem. And you're going to see a lot of companies not be able to support multiples like that. It's a lot harder to push a multiple from 40 to 60 than it is, you know, from say 12 to 18. But I'm going to talk about that a little bit later. Inside that backdrop, the alpha becomes scarce because the good news is already priced in. Recognizing that a chip is faster, that's not an edge anymore. That's consensus. To generate outsized returns in this bracket, like I said, you'd have to push the multiples pretty far. And unfortunately, historically, that usually leads to some pretty painful corrections. I think the artificial intelligence trade is going through what I call in the article a metamorphosis. And for the last couple of years, it's been all about the picks and shovels, the builders, the chip makers, the data center constructors, even the utility companies, all laying, you know, what I call the physical tracks for the AI revolution. That's likely to go on for years, and this build-out will continue. But I think we're going to start to look elsewhere for some of the returns. As we head into 2026, I think you're going to see a lot of banks follow the lead of JP Morgan and Goldman Sachs. They're going to see a lot more notes about the following and about the era of the adopter or the implementator. And all of us are doing that. I'm sure most of you at home are using AI in some capacity, and you're finding it's either freeing up your time or you're able to get more done. Every company on the planet has to have an AI policy. And if you're a CEO of a company, you're listening to this, and you don't have an AI policy, you better get one quick, because you're going to get a call from the board and you're going to be out of a job. Now, JP Morgan framed it this way. They believe that the market is fracturing into what they call a multidimensional polarization. Big word. I dove into that, so I wanted to break it down for myself because I really didn't see where they were going with this until I read the note. But they believe the divide is no longer between tech and non-tech. This part makes sense. They believe it's between companies that can effectively deploy AI to drive ROI or return on investment and those that cannot. The most significant signal of this shift comes from the software layer. Now, software in 2025, rough year. A lot of these companies are trading at 52-week lows. For much of 2023 and 2024, large companies, their customers, attempted to do this on their own, building AI models in-house. Now, that's a phrase characterized by high spending and low production. Well, there's some evidence now that that era might be starting to end. Last week, pretty important week for software fans. Salesforce reported earnings. Now, let me preface this conversation by saying CEO Mark Benioff and his management team are notorious for self-promotion. But this time, I think management struck a chord with investors by declaring that DIY or do-it-yourself AI science projects are largely failing. A lot of customers coming back. Many companies that have tried to implement complex agent architecture have gone from experimentation to complete frustration. Now, the executives highlighted that customers are realizing that they lack the unified data infrastructure to build these very complex autonomous agents from scratch. Now, of course, Salesforce is trying to pivot their customers toward what they call Agentforce. In fact, they might even change the name of their company to Agentforce. That's a platform approach that suggests the next winners will be companies that simplify the chaos of AI deployment by coming back. If this works out, it would validate a crucial emerging theme. That complexity might be the new moat. Companies finding it difficult to roll out complex agents are turning back to established enterprise platforms, software as a service, and even consulting firms to bridge the gap. The Magnificent Seven. You can't have a financial podcast without talking about the Mag 7. And this one's not going to be any different. Why? Because they represent such an enormous part of the market. And if there's any cracks in the armor here, it's going to be painful. So let's look at some charts. I'm going to go back to 2023, right? What you're looking at there on your screen is the Magnificent Seven, and in there, in that white line there, that's the S&P 500. Pretty easy to see that without the Magnificent Seven that year, 2023 would have been a pretty rough year because the other 493 stocks couldn't keep up, right? Let's fast forward to 2024. Little different picture here, all right? A number of the stocks are underperforming the market as a whole, but by and large, the Mag 7 did pretty well. 2025, different story, all right? Only two stocks this year. Alphabet, which came out from nowhere. Everybody thought they were going to be the big-time loser. Now they're number one with a bullet, all right? And NVIDIA, back again this year, was there all 3 years, all right? Without those two, though, would have been a very different story because the rest of the Magnificent Seven is underwater, at least when you compare it to the S&P 500. So you went from all seven to less than seven to two. It begs the question, if this trend continues, what's it going to look like next year? Perhaps the most counterintuitive trend is the resurgence of boring sectors like retail. While often perceived as low-tech, this industry is rapidly becoming a volume adapter of AI for customer retention and margin protection. The retail sector has seen a sharp uptick in adoption, utilizing AI to provide a better customer experience and automate inventory management. And if you're going to talk about retail, you got to talk about the king of the heap. The Empire Strikes Back, Walmart. Walmart is at the top of the list of legacy retailers using AI to push the envelope on almost every aspect of its business model. And for big box retailers, the battle is won or lost in the logistics network. Walmart, often viewed as a traditional brick-and-mortar giant, has effectively transformed itself into a tech company with storefronts. Now, part of that plan is the way they deploy their proprietary AI system that does more than just track inventory. It simulates future supply chain shocks. It models weather patterns and port congestions days in advance. The system can autonomously reroute shipments to alternative ports, ensuring shelves remain stocked when competitors go dry. Now, admittedly, Walmart has a premium multiple, expensive company, and likely much further along than smaller competitors. But you can bet every C-suite from Wall Street to Main Street has an AI policy in place. If AI is really going to make its way through the industrial complex, it's going to show up in productivity and margins. Take a look at this chart of the S&P 500. What you're looking at there are operating margins headed in the right direction. Operating margins are expanding and projected to get larger in the next couple of years. In a recent research note by Goldman's Sarah Dong and Joseph Biggs, they pointed out the following. In the limited areas where generative AI has been deployed, academic studies imply a 27% average uplift to productivity. That's huge for investors and will pay off in stock prices. The opportunity now lies in the adopters. Sectors like healthcare, consumer staples, retail, and industrials. These companies often languish at low double-digit multiples, 12, maybe 16 times price for low growth and eventual obsolescence. Here is the alpha thesis. It is mathematically easier to push a PE multiple from 12 to 18 than it is to push one from 40 to 60. The catalyst? When a legacy retailer uses AI to cut inventory waste by 20% or a utility firm uses predictive maintenance to slash downtime, they aren't just saving pennies. They are structurally expanding margins. Take a listen to this excerpt from the Abercrombie & Fitch A&F conference call. These tech investments have the power to enhance the entire customer journey, especially when paired with AI. We recently deployed AI agents and customer service to improve the experience while driving scale and efficiency. Look at this chart. The setup was perfect. Low expectations, high short interest, and a management team that delivered. Boom. The expectations gap. The ultimate source of alpha is the gap between market expectations and reality. In tech, the market expects miracles. A slight miss in AI CapEx guidance can trigger a massive sell-off. In retail or industrials, the market expects mediocrity. When a boring company reveals it has used AI to personalize customer retention and drive a 5% same-store sales beat, the shock to the upside is violent. If this theory holds, the acceleration in non-tech stocks could dwarf the remaining runway in the tech sector. Silicon Valley has built the engine, but Main Street is getting behind the wheel. For the investor, for the portfolio manager, the goal for 2026 is not to find the next NVIDIA. It is to find the next legacy operator that embraces the technology that will take their business to the next century. That is where the next leg of the bull market and the true alpha lies. Okay, that's it for this week. I hope you enjoyed the podcast and the article earlier this week. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.